Good afternoon, everyone. It's a pleasure to be here. Thank you so much for those kind words, Carol. As she mentioned, my name is Anna Warpy Lillian. I am an enrolled agent with the IRS. And you may ask, what is an enrolled agent? Well, we're a small group of people. We're a smaller group than the CPA community. And we're like CPAs, but we focus on tax. So anyway, I have been working in the tax business for about 7 years now with H&R Block, and most recently with Intuit, the TurboTax business. So today we're going to talk a little bit about the Inflation Reduction Act of 2022. And wow, what an amazing act. I mean, as I started delving into this, I was really incredibly impressed with this whole initiative. So it was signed by President Biden into law in August of the 16th of 2022. And what is the law about? It's basically about delivering progress and prosperity to the American families by building a new clean energy economy powered by American innovators, workers, manufacturers that will create good paying union jobs and cut the pollution that is fueling the climate crisis and driving environmental injustice. It is also part of President Biden's Justice 40 initiative. The law provides for $370 billion, that's a lot of money, in both grants and in loan programs and other investments for clean energy and climate action benefiting working families and the underserved. Part of the funding is utilizing tax credits to incentivize purchases of energy vehicles and home energy goods. Today, we're going to focus on the personal credits that you will apply either to your annual individual tax return, tax liability, or apply to a purchase of a vehicle. So here are some resources for you to keep in mind, and we'll go over those at the very end. You want to check out cleanenergy.gov, or you want to pull the Inflation Reduction Act guidebook. Okay, yes, there's an amazing guidebook with over 200 pages, okay, that goes through all of this. And that you will find at the whitehouse.gov website, or you can go to the irs.gov, and I'll have some more resources for you at the end. So let's get started. Let's focus on clean vehicles, okay? Why was this part of the Inflation Reduction Act? Primarily because transportation accounts for 27% of all emissions as of 2020. I would imagine that number, I don't know, and hopefully the number is either held steady or gone down in the last few years. But the goal is to have at least 50% of all new passenger cars and light trucks sold by in 2030 to be zero emission vehicles. So that's a huge task. We're in 2023, folks. So we've got 7 years to get there. So we've got to be really aggressive. In October of 2022, President Biden also announced the American Battery Materials Initiative, a new effort to mobilize the entire government in securing a reliable and sustainable supply of critical minerals used for power and electric vehicles. And as you all know, the batteries and the battery materials critical to the success of our electrification initiative. So the Inflation Reduction Act tackles these priorities comprehensively by combining incentives for consumers and businesses to purchase clean vehicles with programs to expand manufacturing and sourcing of vehicle components and critical minerals in the United States. The investments in the IRA build on the $7.5 billion provided by the bipartisan infrastructure law to deploy a national network of 500,000 electric vehicle chargers, more than $7 billion to ensure domestic manufacturers have the critical minerals and other components necessary to make EV batteries, and $10 billion for clean transit and school buses. The IRA provides billions of dollars in incentives to put more clean vehicles on the road and commits to making more of these vehicles and their components in the United States. So let's take a look at the two credits that are directed at consumers. So basically, there's the clean vehicle tax credits, and we have two components of it. One is the clean vehicle credit, which applies to new cars, okay, that you just purchased, you're the first owner. And there's the previously owned clean vehicle credit. So let's take a look at new cars. So the description of this tax credit is it provides a tax credit for purchasers of clean vehicles. The period of availability, vehicles placed in service in 2023 through 2032. Okay. The tax mechanism, it's a tax credit for consumers, and we'll talk a little bit more of what that exactly means. Is this a new or modified provision? Modified and extended. So as you recall, we have had previous tax credits for vehicles or for clean vehicles, but this is a modification and an extension of that. So the credit extended with new rules pertaining to the final assembly in the United States with critical minerals, battery components, and foreign entities of concern. So who are the eligible recipients for the clean vehicle tax credit? The tax credit is not available for consumers who have adjusted gross incomes for the current or preceding year above $300,000 for married, filing jointly, $225,000 for heads of household, or $150,000 for singles. So if you fall any in the last year or in this year above any of those thresholds, and if you want to see what your adjusted gross income is, you're going to have to go back to your tax return and look at your 1040, and there is a line that is called your AGI. It is not your total income. Okay, this is your adjusted gross income. So there's some adjustments that are done, modifications, adding and subtracting to get to this number, okay? So take a look at your previous tax return, look at this year's tax return and see if you qualify. The amount of the credit depends on when you place the vehicle in service, which means when did you take delivery? It has nothing to do with you when you purchased the car. It has to do when you actually took delivery of it. That's what the IRS refers to placing the vehicle in service. So vehicles placed in service January 1st to April 17th of 2023, you do qualify, but they do base it on different criteria than if you were to purchase the vehicle after April the 17th. So it's still $7,500 credit, okay, but it does require it does say that you have to follow these three criteria. There's a $2,500 base amount, and then there's this 417 with at least 7 kilowatts and 417 for each kilowatt hour of battery capacity beyond 5. But let's move on and look at what is currently the requirements for vehicles. So for vehicles placed in service after April 17th, they have to meet the same criteria listed on the previous page, plus they meet new critical mineral and battery component requirements for a credit up to 3,750 credit for vehicles meeting the minerals requirements, and an additional 3,750 credit for vehicles meeting the requirement that a threshold percentage of battery components be manufactured or assembled in North America. This is where the beauty of the IRA and these modifications are really focusing in on making sure that the assembly is done in the United States. Okay, so the maximum credit is $7,500. That's awesome, guys. So the vehicles must meet other requirements, including final assembly in North America, which includes Canada, US, and Mexico. The manufacturer's suggested retail price cannot be greater than $55,000 for a standard vehicle, And for vans, SUVs, and pickups, no more than $80,000. Okay. So that's very, very important to understand. There are income limitations and there are a lot of limitations on the pricing of these cars in order for you to qualify. So starting in 2024, there's also some changes. Qualifying vehicles cannot have battery components manufactured or assembled by a foreign entity of concern. All right, I did not look up who those foreign entities are. Figured we didn't need it for this exercise. Starting in 2025, qualifying vehicles' batteries cannot contain critical minerals extracted, processed, or recycled by a foreign entity of concern. Okay, transferability. So starting in 2024, this credit can be transferred only to the dealer at point of sale. So I believe that means that you will be able to take that credit at the dealership. So I want to confirm that before I state it for sure, but that's the way I understand the transferability. But the question is, how is your dealer going to know whether you qualify from an income perspective? So I'm not quite sure how that is going to be done. Okay, so we'll have to stay tuned for more info on that. Okay, so please note that you can use your modified AGI, we talked about what that is, from the year you take delivery of the car or the year before. So if you earned less money in 2022 and you took possession, bought the car, took the possession of it in 2023, but 2023 you made more money, guess what? You can still claim the credit. Okay, so this is a beautiful part of this credit. So the credit is non-refundable. So that means that you can't get back more on the credit than you owe in taxes. This is really, really important point because a lot of people think a non-refundable credit means that, you know, you're just going to get it and you're going to get that money back somehow, you know, the full $7,500, but you're not. So if you have a tax liability of $5,000, you're only going to be able to apply $5,000 of that $7,500 towards that tax liability. So you will not get the full $7,500. I do not believe that that's transferable to the following year, but that is, yeah, no, it's a non-refundable, so it wouldn't be. I don't think it carries forward, but I will check on that. But I believe it does not. So you would just have to plan. This is where tax planning comes in, right? You know, you want to buy a car, you got to take a look. You got to, you know, understand what your AGI situation is, right? And you need to do some tax planning. So maybe you don't take a full withhold, you don't, you know, do the full additional withholding, or you manage your estimated taxes, or you decide to sell some stock in the year that you're going to take this credit so that you have a tax liability to utilize the credit against. Okay, so to claim the credit, you're going to use the form 8936, and I assure you any of your tax software that you use or your tax professional or preparer will know exactly what to do. One important thing to note is to get your credit from the dealer, the seller reports the required information to you at the time of sale and to the IRS. Okay, so this is why you want to go through a dealer to buy these new cars. All right, because there has to be a reporting of the sale both to you and to the IRS so that you can report it properly on your tax returns. Okay, used cars. So once again, for vehicles placed in service in 2023, this is a new provision, okay? This is something we have never done before, giving you a credit for purchasing used cars. And the reason for that is that they recognize that a bulk of Americans purchase used cars. It's a huge market. And if we're really going to be making a dent on getting people to convert to clean vehicles, we have to get that. We need to apply a credit to the used cars and incentivize people to buy used clean vehicles. Once again, there is a limitation on your adjusted gross income for either the current or the preceding year. So if you make over $150,000 as filing as married, filing jointly, $112,500 heads of household, or $75,000 for singles, you will not be able to get the credit. Okay. All right. The individuals can claim only this credit once every 3 years. You must purchase the car for your own use and not for resale. And the vehicle must be sold by a dealer. Very important. A lot of people buy used cars from individuals. That is not going to count. You're going to have to go to a dealer because the dealer has to report the transaction both to you and to the IRS. And the sale price must be $25,000 or less. Okay. And this credit can only be claimed once per vehicle. So there are limitations. Okay. So what is the credit? It is the lesser of $4,000 or 30% of the sale price. So the most you can get is $4,000, but that's a lot of money. Let's say you buy a car for $16,000. You just got 25% off, right? If you have a tax liability. Okay. And it says, yes, that starting in 2024, it's transferable only to the dealer. And once again, I need to confirm all that. All right. And to qualify, a vehicle must meet all of these requirements. We talked about sale price of $25,000 or less. Different sale price than a new car, right? That was $55,000. For a used car, sale price must be $25,000 or less. It has to be a model year at least 2 years earlier than the calendar year when you buy it. So it has to be at least 2 years old. All right. It could not have already been transferred after August 16th, 2022 to a qualified buyer. Well, there's several things here. To find out more, and here's a really important thing to do. You've got to go to fueleconomy.gov, and there it's going to let you know specifically if your car or the car that you want to purchase qualifies for this credit, okay? Because there are limitations on gross weight, and battery capacity and all of that stuff. Okay. The sale qualifies only if you buy the vehicle from a dealer. Okay. For qualified used EVs, the dealer reports, we already mentioned that, to the IRS and to you. And this is all of the information that has to go in that. Okay. And as I mentioned before, you can use your modified AGI from the previous year or this year, which is awesome. Again, the credit is non-refundable. You guys all know what that is, right? Okay, you must have a tax liability in order for you to utilize this credit. To claim the credit, get once again, Form 8936, and any of your software or tax preparers will know about that. So now let's turn our attention on some additional tax credits for consumers, which is the energy efficiency home improvement. These are the home energy credits, and there are two primary ones that we're going to be looking at. So this one focuses on lowering energy costs for American families so that they can keep their homes warm in the winter and cool in the summer. Monthly energy bills can be a particular burden for families trying to make ends meet. We all agree with that. So the IRA will help households afford energy efficient appliances and upgrades when they need to make home repairs so they can save money on their energy bills for years to come. The Inflation Reduction Act empowers and equips homeowners who want to make upgrades so they can save energy and reduce their costs. And the new credits and deductions in the IRA can reduce the cost of energy efficient home upgrades, including heat pumps and other appliances, windows, doors, and more. It offsets the cost of adding residential clean energy sources, including solar panels, battery storage, and making constructing energy efficient single and family homes cheaper and easier. Okay. So the energy efficiency home improvement credit, okay, is for a period from 2022 to 2032, which is where all these credits are covering the next 9 years, okay? Once again, it is a modified and extended credit because we have had this credit in the books in the past, but it's been increased from 10% to 30%. That's a threefold increase. That's awesome. It's $500 per taxpayer. Lifetime limit was eliminated because there was a very low credit and it was just a one-time lifetime. All of that has been replaced, eliminated with increased annual limits. This is a very rich credit. Eligible recipients, homeowners, rentals for certain improvements. Property must be located in the United States and it cannot be a new home. Remember, this is for existing homes. It must be your primary resident and it must be an older home. We're talking about upgrades, enhancements, improvements to your home. Okay, so once again, credit amount is 30% of the cost with limits for each type of improvement and total per year. So the credit is capped at each year at $600 for efficient heating and cooling equipment, $600 for windows, $250 per door, $500 total for doors, $2,000 for heat pumps, $1,200 for qualified energy efficient improvements to the building, including insulation and air sealing. Okay. Total annual credit capped at $1,200 with a separate annual $2,000 limit for heat pumps. So the total is $3,200. Okay. And it also includes a $150 credit for home energy audits, which is really, really cool. This is something completely new, and we'll talk a little about that in just a moment. So what are the building envelope components and what does this cover? I'm just going to go through this quickly. I just want you guys to have an idea because I'm hoping to get everyone excited about going out and calling Home Depot or their favorite supplier or contractor and, you know, take a look at what are the things that we can do around our house to make it more energy efficient, right? So it covers exteriors, doors, that meet applicable Energy Star requirements. The credit is limited to $250 per door and $500 total. Exterior windows and skylights. Everything must meet certain criteria in terms of Energy Star certification. So that is something that your contractor or the salesperson at the stores that you go and shop at, they should have all of this information for you to make it easy for you to make those decisions, okay? So the credit is limited to $600 for windows, insulation and air sealing materials or systems that meet international energy conservation codes. And let's see, what is that one at? Okay, this is the one that's $1,200. Okay, in effect at the start of the year, 2 years before installation. Okay, let's look at this example. Materials or systems installed in 2025 must meet the IECC standard in effect on January 1st, 2023. These items don't have a specific credit limit other than the maximum credit limit of $1,200, okay? Just to note, labor costs for installing these what they call building envelope components don't qualify for the credit. This is why we're talking today. Lots of little details, and you don't want to go out and start spending a ton of money without understanding really what your credit is going to be, okay? But this is, you know, if you do it right and calculate it right and get the right people behind it, shop at the right places, and, you know, really think it out, it's a nice additional credit, okay? All right, so now we have the home energy audits. This is something completely new. So now you can go and request an energy audit of your home and get a credit for $150, okay? This is a written report and inspection that identifies the most significant and cost-effective energy efficient improvements with respect to your home, okay? It includes an estimate of the energy and cost savings with respect to such improvement. This is really where you start. So if you have a question like, where do I get started? Okay, in making my home, improving my home, making it more energy efficient, this is where you start. You start with a home energy audit, okay? And you could probably Google it and find a bunch of names of people in San Diego because they are supposed to be, I think, certified in order to do this. Okay. The third component of the efficient home improvement credit is residential energy property. Okay. So this includes upgrading central air conditioners, natural gas, propane, oil water heaters, natural gas, propane, or oil furnaces, and hot water boilers. Okay. And there is a limit of $600 per item. Okay. Heat pumps and biomass stoves and boilers are also included. This is the one that has the additional credit of $2,000. Remember, it's $1,200 for all the others. So kind of limited, but you do it every year. You've got 9 years to get this done, folks, right? So each year, take advantage of the 3,200. You may not be able to do the 2,000, but, do a couple doors every year. All right, heat pumps and biomass stoves and boilers with a thermal efficiency rating of at least 75% quality for a credit of $2,000. Okay, that's great. All right, so once again, the credit has no lifetime dollar limit, okay, because that's what happened before. That's gone. You can claim the maximum annual credit every year that you make eligible improvements until 2033. Okay, that's awesome. Actually, 10 years. Once again, the credit is non-refundable. So think out how you want to do. You don't want to be at the end of the year, you did all this, you're looking forward to getting the credit, and then there's no tax liability. You've got a refund, right? That means you're not going to get any of these tax credits. So hopefully you're going to talk to your tax preparer or somebody to get a little tax planning in place. And it's Form 5695. All right. Final, residential clean energy credit. This is a different credit. This provides a tax credit for the purchase of residential clean energy equipment, including battery storage with a capacity of at least 3 kilowatts. Once again, period of availability, 2022 through 2032 with a phase down, okay? This is a modified and extended version. We've had this before. So now the credit's been extended at 30% of cost through 2032 with a phase down through 2032. Battery storage is newly eligible for 2023. So that's the battery storage in your garage for your EV vehicle. Biomass fuel property credit has been eliminated. That was part of it before. Who are the eligible recipients? Well, homeowners, including renters, it must be, again, your primary residence. There are certain rules. If you use your home for business, the IRS is going to require you to take only the percentage of the home square footage that is your primary residence. So it will exclude the business portion of it. So if you have a home office that accounts for 10%, you're only going to be able to take 90% of that credit, okay? Because it only applies to the primary residence. It's available for both existing and new homes, okay? So different from the other one. Must be a US-based location, and actually second homes are eligible. So we really want you guys to take advantage of this and apply it to a second home. So once again, it's 30% of the cost of the equipment through 2032. Then it drops down to 26% and 22%. So qualified expenses, okay, include the cost of new energy property. It cannot be anything old equipment, okay? It must be purchased new, all right? Solar, electric panels, solar water heaters, wind turbines, geothermal heat pumps, fuel cells, battery storage technology. Okay. They may include labor costs. Remember, the other ones in the past, the previous one did not include labor costs. So this is why it's really important that you get to the nuts and bolts of what these credits include, because some of them include labor costs, some of them don't, right? And it does include solar roofing, although it doesn't obviously include traditional roofing, because that's not clean energy. So if you have a solar roofing tiles and solar shingles, those would qualify. Okay. The clean energy property must meet the following standards to qualify for the residential clean energy credit. Solar water heaters must be certified by the Solar Rating Certification Corporation or a comparable entity. Geothermal heat pumps must meet Energy Star requirements. That's why you want to go to reputable places to purchase all of these, enhancements or improvements for your home, equipment, appliances. You want to go to places where they're going to be able to show you that these are Energy Star requirements, or they have the solar rating certification behind them, right? Battery storage technology must have a capacity of at least 3 kilowatt hours. Okay. Now, when you're calculating your credit, this is really important. You may need to subtract any subsidies, rebates, or other financial incentives from your qualified property expenses, because they're considered future purchase price adjustments. That makes sense, right? Can't double dip. So if the state is giving you a huge rebate on your solar panels, you're going to have to deduct that from the cost, and then you're only going to be able to apply the credit, the 30% off of the balance, okay? Just so that everybody understands. If you occupied your home jointly with someone other than your spouse, each occupant must complete their own Form 5695 to take the credit. And the reason for that is that you have to have a certain, let's see, how does this account? The maximum qualifying costs that can be taken into account by all occupants for qualified fuel cell property costs is $1,667 for each 1/2 kilowatt of capacity of the property. Okay. And so it's kind of, the rules don't apply if you're married filing jointly with your spouse, but they do apply if you have other people living in your home. Okay. And it is limited in that regard. And I don't quite understand it because I'm not sure about the 1/2 kilowatt of capacity and the amounts on that, but that is the only limitation to this particular credit is this. Okay. Just so you know. All right. So you're going to file Form 5695. Once again, the credit is non-refundable. Okay. The credit has no annual lifetime dollar limit, except for the credit limits for the fuel cell property, which we just talked about, right? You can claim the annual credit every year that you install eligible property until the credit begins to phase out in 2033. All right. And just in case I confused you a little bit today, which I would not be surprised because there's a lot of information out here, and I get it. That's why it's so important to have conversations like this and to really dig in into the nuts and bolts of these credits so that you can understand, plan, right? And then hopefully execute. All right. So more resources, well, www.irs.gov/credits and deductions. And that is going to take you, you'll see home energy credits, and you'll see clean vehicle credits right on the front page there. Click on that and you'll get more info. Go to cleanenergy.gov. And if you really want to read the Inflation Reduction Act, go for it. And download the Inflation Reduction Act guidebook. from the whitehouse.gov website. So with that, I thank you so much for joining me today. And if you have any questions, feel free to email me. Carol, you can give everybody my email address and I'd be happy to answer any questions. So thank you so much.
You aren't going to answer them now?
Oh, I can answer questions now. Sure. Well, it was 12:58 and Carol said it was an hour. So
well, she can leave and you can, we can talk.
Okay. Did you want to start the recording?
She did record it. Yeah.
I know. Yeah, but she may want to stop it at this point, or do you want to keep it going?
Sorry. Go ahead with your question, Mary Ellen.
This the tax credit thing. I paid for my own solar and didn't get any tax. I mean, was supposed to get a tax credit, but guess what? People who don't owe taxes get nothing. So this stuff is fine for middle class, but it's not going to do anything for getting low income people away from their gas guzzling cars. Very poorly planned. It's wait.
Well, I understand it is, even though the intention of the IRA is very much to hit lower income working families, I do agree with you because I'm in the tax business and lower income people generally have refunds because they take advantage of all of the other refunds that are out there. Credits that are out there. They usually don't owe a lot of money. So I understand that. And that's why I think they really should rethink it. And I think it'd be great if you could just take that off of the price of the vehicle. If you make a certain amount of money, if you make less than.
Yeah, like that would be nice and simple.
Then just take it off, but I'm not Congress.
But
neither is Congress.
I think they are, will be hitting a lot of people, that do pay taxes and do want to make improvements to their house. And I really like your idea of, take the $600 or the $1,200 or the $3,200 improvements on your house every year. Yeah. So I think that's a really good idea. And I'm going to try to do that.
And tax plan, Carol, sell some of your stocks or, lower your,
it would be a good
thing so that you have some tax liability at the end of the year.
It'd be a good time to just clean out your IRA.
Yeah, or clean out your IRA or your retirement. Here's a good one. Do a conversion from your traditional IRA to a Roth IRA. That would be a great year. That would be a great thing to do. In fact, that's what I'm going to do. Then that way I'll have a tax liability because I've got to pay tax on the traditional IRA that I'm converting over to a Roth.
Right. Happy to help.
So I wanted to say one thing. I got new blinds in my house this last year, and I was told I could get $1,200 tax credit for the blinds, and that the Hunter, the Hunter blinds gave me all the information to do so. But that's next year's tax. Because
blinds are the same thing. I think
it's part of the IRA. Yes. So it's part of that guidebook.
Right. Yeah. So I think it's great. Now, remember, there are income limitations. So, if you take over those thresholds, the 300,000 for married, finally, wait a minute. Wait a second. There are not
for the energy efficiency
thresholds for the electric vehicle. I believe there are no AGI thresholds for the home improvement. And for the residential. Yes, that's only for the EVs.
Wonderful. Well, that's really, thank you so much, Anna. Does anybody else have any questions right now?
No, but I really appreciated this. I think only a tax wonk could love this. So, well done, Anna.
All right. Well, thank you.
Okay. Well, thank you. And we're going to put this up on our YouTube channel. So thank you so much, Anna.
All right. Thank you. You guys have a great day.